Today, I'm talking about conventional loans. Watch this video to see if this is the type of loan you might qualify for, or if it doesn't quite seem like you, have a look at other videos in this series to discover what other types of loan programs are available. But truly, the best way to find out what loan is best for you is to talk to a lender. Actually, talk to several, and I'll talk a little bit more about that later. I am Jordan Quinn of Jordan Quinn Real Estate, and this video is all about conventional loans, which are mortgage loans that are not backed by a government agency like Fannie Mae or Freddie Mac. These loans are offered by banks, credit unions, and mortgage brokers. The type of borrower that would typically qualify for this type of loan is a person with a good credit score, money for a down payment, and a qualifying debt-to-income ratio. The interest rates and qualifications for this type of mortgage can vary significantly between lenders, so it's really important to shop around. Now, conventional loan terms tend to fall into two narrower sets of categories, which are called conforming and non-conforming loans. This is where it gets a little confusing because, as I said earlier, that conventional loans are loans that are not backed by government agencies, yet conforming loans are loans that abide by or conform to government agency lending standards put in place by Fannie Mae and Freddie Mac. Most notably, these lending standards determine the possible size of the loan by setting conforming loan limits, which for 2022 for a single unit, single family home is $647,200. This is the limit for most of the United States, but there are exceptions for high cost areas. So I've included a link in the description with an interactive map where you can find the limit in your area that you're looking to live or invest. Loans that exceed this limit are called non-conforming or jumbo loans, and the qualification requirements can vary even more in their limits, rules, and conditions, as they tend to present a larger risk to the lending institution, which means that they tend to come with higher interest rates as well. Conventional loans are more accessible to those with a middle or high income, and they require a sizable down payment and favorable financials to secure a reasonable interest rate. The three most common assessment criteria used to determine eligibility are your credit score, your debt-to-income ratio, and the down payment amount. Your credit score is essentially a measure of your trustworthiness, and it is based upon your ability to pay your debts in a timely manner and how well you utilize your credit. Having a high credit score can have a significant impact on interest rates offered to you, so it pays to work on your credit score before you apply for a mortgage. Another determining factor is your debt-to-income ratio. This ratio determines how well you will be able to keep up with your loan payments. It is the total amount of spend on debt that you have on a monthly basis divided by the amount of income you bring in to cover that debt. How much debt you have includes your auto loans, student and personal loans, credit cards, loans that you are co-signers on, which could be your kids' student loans as well, and your medical debt. If your DTI is too high, you may need to lower it by consolidating your debts into a lower payment or getting a raise at work. And the third factor is your down payment. And as you may have heard that you have to have a 20% down payment, well, on a $300,000 loan, that's $60,000. Not a lot of people have that just laying around, so don't panic if you don't have it, because 20% down payment requirement isn't true. The more deposit or down payment that you put down can lower your interest rate, but there are lenders that will accept as little as 3%. However, a down payment of less than 20% will require PMI or private mortgage insurance, which is paid by you to protect your lender in case that you cannot make your mortgage payment. The smart thing to do is to shop around, evaluate your lending options with as much scrutiny as the lender will be using to determine your eligibility. And definitely look at various types of lenders, from a credit union, a mortgage broker, or a bank, to find out what best suits your needs. Once again, I am Jordan Quinn of Jordan Quinn Real Estate. And if you found this information useful, don't forget to like, share, subscribe, and then hit that bell icon so that you don't miss any future videos that I post to this channel. And as always, I wish you the gift of a most wonderful life. Thank you very much for watching this to the end.